Welcome to the B.F. Anderson Technical Report for September the 9th. NASDAQ continues in an uptrend. We are getting somewhat of a little bit of a pullback today, holding that 10-day moving average. However, continues to be in an uptrend. Weekly graph, no problem whatsoever. 35-week moving average, very solid uptrend. We are in a bull market. Mid caps, however, we're getting somewhat of a failed breakout here. We had a breakout above this base. However, it looks like it could be failing. So we're not out of the woods yet, but we are seeing continued strength in the large caps, whereas the mid caps and the small caps are iffy. Here's the New York Composite again, somewhat of a failed breakout, same thing. Here we are on the small caps, failed breakout. We broke out above this base, pulling back in again. The market continues to be very focused on just a small segment of the market, which is pretty much causing the indexes like the S&P and the NASDAQ to outperform where everything else is kind of holding back. Here is the S&P 500, as you can well see, but we are breaking below that 10-day moving average. That's a break. That's not a violation. This would be a violation here. However, it just resumed the uptrend very quickly. Here is the weekly. Now, I really do consider the weekly to be one of our better indicators. It's just been so solid all through this period. Okay, here's the aggression index. We started to really break out here. Now we're kind of leveling off a little bit. However, we did make a higher high after making a higher low. So it's basically in an uptrend. Interest rates continue to somewhat stay around the 200-day moving average. Kind of vacillating in here, however, has been kind of popping up a little bit. Oil stocks continue to be somewhat weak. The price of oil really just can't get back above 70. The financial stocks continue sideways to down. Nothing really happening there. The new lows are starting to settle down. Now, this is good news. Now, we'll talk a little bit more about the new lows. I went back and did somewhat of a long-term analysis, but basically starting to settle down. The inverted yield curve starting to improve. We've turned back up because interest rates have kind of popped back up a little bit. However, no inversion, so therefore no recession. The sentiment looks improving on the retail side. However, on the institutional side, we continue to stay in the greed. The fund managers are just very optimistic. The Russell 2000 Growth ETF continues to somewhat fail in a breakout. We were hoping to break out above this line here. However, we rallied up, somewhat failing. We'll have to see how it goes. Junk bonds, we are seeing an improvement in the junk bond treasury bond ratio. Low, higher low, higher low. Now we just made a higher high. So it looks like, again, I don't think the economy is in trouble. I don't see a recession on the horizon. However, we are starting to see a little bit of signs of inflation. Volatility index continues to stay at a very acceptable level. No problem there whatsoever. Like I say, this is a bull market. Now, on the new lows, what we want to look for there, if we go back to like 2018, you can see a really big spike in the new lows on the New York Stock Exchange. Again in 18, and you can see what happened here. The market kind of really sold off. But we're looking for extreme levels here. However, we don't like to see new lows exceed 40 a day. However, a really big spike in new lows usually goes hand in hand with a pretty serious downtrend, but we'll have to watch it. Okay, now this is a ratio that I came up with where I'm comparing the NASDAQ to the S&P 500. You can see here this ratio, and it's a ratio now, peaked around in February 10th actually. We came down, we made a low. So here we have a pattern that's called an inverted head and shoulders pattern. Here's your left shoulder, here's your head, here's your right shoulder. So what we want to see is a decisive breakout above this level. But it is definitely improving. This ratio is definitely improving. So we're starting to see somewhat of a resurgence of the growth stocks, especially cloud-based softwares. Now, on inflation, I mentioned that inflation was kind of perking up. This is another ratio I'm doing. This is the TIPS bond, which is the inflation-protected securities bond, compared to the traditional treasury bond. You can see where we're starting to see some improvement in the ratio where it favors the inflation-protected bonds. So we are starting to see the market somewhat looking for additional inflation. Now here we have another ratio. This is where I'm comparing U.S. technology ETF to the S&P 500. So you can see here, again, we have the peak in February. The ratio came down, left shoulder, right shoulder, inverted head, in an uptrend. So it does look like technology stocks are starting to somewhat take a lead again. Now here are the top 5. This is Asana. This is a software company. We own the stock. We got a nice gap up on earnings, and we're starting to see what we call an ascending flag formation coming off this pole. So it looks very positive. This is Bill.com, another software company. Again, the pole, ascending flag. This is a very positive formation. Here we have Lending Club. This is an interesting deal. We got a gap up on earnings, ascending flag. Stock continues to be in an uptrend. They're mainly I checked out their webpage. They lend, like for car loans, they'll lend you $40,000 at very reasonable interest rates. So you can consolidate credit cards, you can buy a car, whatever, home renovation, so forth. Here's Lightspeed. Now this is an interesting company now here. Somewhat extended, kind of a big rally in here. This company is like a Shopify, but what they specialize in is in the hotel type of businesses. The where you would want to go to a web page for a hotel or places to stay. Here is Sprout Social. Again, this has to do with advertising on the internet. We got a nice little buy signal here. Ascending flag formation continues to be very strong. So that's it. If you have any questions, please give me a call. Thank you very much.